You've driven past it 100 times. That long beige building off the highway, roll-up doors in even rows, a faded sign with a phone number nobody ever calls. You've probably never once wondered who owns it. Here's the uncomfortable truth. Whoever owns that building is likely making more money per square foot than the coffee shop next door, the gym down the road, and half the office buildings downtown, combined. Self-storage isn't the boring backup business people assume it is. It's one of the highest margin real estate plays in the country, and almost nobody treats it that way. Today we're breaking down exactly what it costs to own one, how the money actually moves, what you'd really take home after everyone gets paid, and the one thing that quietly wrecks more storage owners than anything else in real estate. Let's start with the number that gets you in the door. You don't have to build a storage facility from scratch to own one. Most first-time owners buy an existing facility instead. Why? Because a stabilized, already occupied property is dramatically easier to finance, and lenders love it. The Small Business Administration backs two loan programs built almost exactly for this situation, called the SBA 7A and the SBA 504. For a first-time buyer, the standard down payment is 10% of total project cost, not just the sale price. Total project cost means the purchase price, plus closing costs, plus working capital, plus a cash reserve to cover your first year while occupancy stabilizes. Let's put a real number on it. A modest, already stabilized 40,000 square foot facility with solid occupancy might sell for around $2 million. At 10% down, that's $200,000 of your own cash to walk in and own it outright. Compare that to opening a hotel, a car wash chain, or a strip mall, and storage suddenly looks almost affordable for what you're actually getting. Some deals get even leaner. A handful of sellers will accept just 5% down in cash if they agree to hold the remaining 5% as what's called a standby seller note, meaning no payments, no interest, nothing owed to them until your primary loan is fully paid off. Is $200,000 still real money? Absolutely. But for a business that owns actual dirt, actual buildings, and monthly cash flow from day one, it's one of the lowest true barriers to entry anywhere in commercial real estate. Who's actually sitting across the table from you in a deal like this? A commercial lender underwriting the loan and picking apart every number in your business plan. An SBA-approved certified development company handling the government-backed slice of the financing. A property manager, if you're not planning to run day-to-day operations yourself. And three giants looming over the entire industry from a few exits down the highway. Public Storage, Extra Space Storage, and CubeSmart, the companies that dominate self-storage nationally and quietly set the pricing benchmarks every independent owner reacts to. You're not just buying a building when you sign that loan. You're stepping directly into a market these three companies have already mapped out, block by block, zip code by zip code. Now here's where the math gets genuinely interesting. Let's run the numbers on that same 40,000 square foot facility. Say it holds 300 individual units, mixed between small, medium, and large. Average monthly rent across that whole mix lands around $120. Fill 80% of those units, a completely realistic, industry normal occupancy rate, and that's 240 units generating rent every single month. 240 units times $120, that's $28,800 a month before you've done a single extra thing. Multiply that across a full year, and you're already past $345,000 in gross rental income. Now stack on the extras. Late fees, mandatory tenant insurance upsells, lock and box sales at move-in, administrative fees on every new lease. Tack on another $15,000 to $20,000 a year just from those small add-ons. Suddenly you're sitting on revenue north of $360,000 annually. From a business with no employees clocking in every morning, no perishable inventory sitting on a shelf, and almost no customers physically present on site most of the day. Can you name another business where the product just sits there, silent, behind a locked door, while people pay you every single month to leave it exactly alone? But that top-line revenue number isn't what actually lands in your pocket. And this is the part most first-time buyers skip past too quickly. Self-storage runs on some of the leanest operating costs of any commercial real estate category, typically landing between 35% and 40% of revenue. That figure covers property tax, insurance, a part-time on-site manager or a remote management software system, marketing spend to keep the units filling, utilities, and routine maintenance. On $360,000 of revenue, that puts operating expenses somewhere around $130,000 to $145,000. Subtract that, and you're left with roughly $215,000 to $230,000 in net operating income, the number lenders and buyers actually care about, before a single loan payment goes out. Now subtract the loan itself. On an SBA-backed loan of roughly $1.8 million at a 25-year term, expect somewhere around $150,000 a year in debt service, depending on the rate you locked in. Run that math all the way through, and your real, actual take-home, the cash that hits your account after the bank gets paid, lands somewhere between $65,000 and $80,000 a year. Is that life-changing money in year one? Not exactly. But look at what you actually did to earn it. You put down $200,000, and in exchange, you now hold equity in a $2 million asset, an asset that historically appreciates in value while your tenants' monthly rent checks quietly pay down your mortgage balance for you. Industry data consistently puts cash-on-cash returns for storage buyers somewhere in the 7 to 12% range annually, which stacks up favorably against almost anything else you could do with that same $200,000 sitting in a brokerage account. There's one more number worth knowing before you ever sign anything, and it's the one that determines what this whole thing is actually worth if you decide to sell it down the road. Self-storage facilities typically trade at around 4.6 times their annual seller's discretionary earnings, a figure known in the industry simply as the SDE multiple. Essentially, the total real profit the business generates for its owner in a year, multiplied by roughly 4.5 to arrive at a fair sale price. Run that math against our facility, and a business generating somewhere around $220,000 in owner earnings could realistically sell for well over $1 million above what you originally borrowed to buy it. That's the quiet second engine running underneath the monthly cash flow the whole time. You're not just collecting rent checks. You're building toward an exit number that can dwarf everything you collected along the way. There's a counterintuitive truth buried in all of this that most people get backwards. You'd assume a business like self-storage would struggle when the economy turns rough. It's the opposite. Self-storage is one of the few real estate categories that's genuinely recession-resistant, and sometimes recession-proof. When the economy slows down, people downsize their homes, move in with family, go through divorces, relocate for new jobs, or shut down small businesses, and every single one of those situations creates a new storage renter, not a lost one. Public storage and extra space storage have both posted remarkably stable occupancy numbers through past downturns specifically because of this pattern. Bad news for the broader economy tends to be quietly good news for storage owners. There's another piece of this business most people never think to ask about, and it's the difference between owning the real estate directly and owning a piece of it through a REIT, a real estate investment trust, essentially a company that owns hundreds of properties and sells shares of the whole portfolio to investors. Buy shares of public storage on the stock market, and you get instant diversification, total liquidity, and zero say in a single operational decision. Buy one facility yourself, and you take on real work, real risk, and real decisions. But you also unlock advantages a REIT investor never sees, like cost segregation, an accounting strategy that lets you accelerate depreciation on specific parts of the building to significantly reduce your tax bill in the early years of ownership. Direct ownership is slower and heavier. It's also where the real leverage lies. Before any of that math matters, though, there's a quieter gatekeeper standing in front of every deal, your local zoning board. Not every plot of land, and not every existing building, is legally allowed to become a storage facility. Some cities zone self-storage as an industrial use, some allow it under commercial, and plenty of neighborhoods actively fight new facilities out of concern over traffic, aesthetics, or property values, since a row of roll-up doors doesn't exactly photograph like a boutique. That fight, called an entitlement process, can add months, sometimes years, and real legal fees onto a ground-up build before a single shovel touches dirt. It's one major reason buying an existing, already permitted facility is the faster and far more common path in for a first-time owner, and why that stabilized $2 million deal from earlier tends to close in weeks, not years. Even once you own the building, one decision shapes your numbers more than almost anything else. Unit mix. Do you fill the facility with small 5x5 units, the kind people rent for a few dorm room boxes and an old bike? Or do you lean into larger 10x20 units built for someone emptying an entire house? Smaller units rent for less in total dollars, but they command a dramatically higher price per square foot, since a tenant paying $60 for a tiny closet-sized space is effectively paying far more per foot than someone paying $220 for a two-car garage-sized unit. Climate-controlled units push that per square foot number even higher, because they protect furniture, electronics, and documents from heat and humidity, but they also cost meaningfully more to build and to run, thanks to the added insulation and HVAC load. Get the mix wrong for your local market, and you'll either have a facility full of tiny units nobody in a family-heavy suburb wants, or a facility full of oversized units sitting empty in a market full of college students and young renters with a handful of boxes. So what actually wrecks the people who try this? It's not the tenants. Storage tenants are famously low maintenance, and nobody's storage unit has ever called you at 2 in the morning about a broken toilet. The thing that wrecks storage owners is oversupply. Self-storage looks so simple and so profitable on paper that over the past decade, developers flooded certain markets with new facilities, all chasing the exact same pool of renters within the same few miles. When too many buildings open in one area, occupancy across that entire submarket drops, and everyone starts cutting rates to compete, including U-Haul, whose truck rental locations increasingly double as branded storage facilities, adding even more competition to markets that were already crowded. A facility that pencils out beautifully at 85% occupancy can quietly bleed cash at 60%. And once you're bleeding cash on a loan with 25 years left on it, there's no quick fix. You can't unflood a market you already bought into. First-time buyers who skip real due diligence are almost always the ones who get hit hardest. That means actually counting how many competing facilities already exist within a 5-mile radius of your target site. It means checking how full those competing facilities currently are, not just how full the seller claims their own facility is. It means verifying every number on the rent roll, the list of current tenants, and what they actually pay, against real bank deposits and real management software reports, because sellers routinely inflate occupancy and rent numbers to make a deal look better than it is. Experienced buyers typically discount a seller's stated cash flow by 15 to 50% until every single line item checks out against real evidence. It means being honest, before you sign anything, about whether the surrounding market can genuinely support one more storage facility, or whether you'd just be the newest competitor in an already crowded field. Boring diligence beats an exciting spreadsheet every single time in this business. If you were seriously pursuing this, the most useful thing you could do this week isn't touring buildings or calling brokers. It's pulling up a map of your own city, marking every existing self-storage facility within a 5-mile radius of a location you're curious about, and simply counting them. That single exercise, done honestly, tells you more about whether a deal will work than almost any spreadsheet a broker hands you. So the next time you drive past that beige building with the roll-up doors and the sign nobody calls, look again. It's not a forgotten warehouse gathering dust off the highway. It's a quiet, high-margin real estate machine, owned by someone who sat down, ran the actual numbers, and understood exactly what that building was worth before you ever thought to ask.